Did you know that as a public employee in Washington state, your pension could actually create a tax problem in retirement, one that could cost you thousands of dollars? Here's the thing, most public employees that I work with have no idea that this exists. Today, I'm going to show you exactly how to set your retirement accounts up to minimize your taxes and maximize your income. If you're contributing to a state retirement plan, you want to pay attention to this video. Hi, my name is Seth. I'm a CPA and financial advisor with Life Focus Financial Advisors. I used to be a city employee and now I'm a financial advisor. I love working with public sector employees in the state of Washington, and I truly understand the challenges and the decisions that you have to make in regards to your benefits and pension. In this video, we're going to talk about how do we set up our savings to minimize taxes and maximize income in retirement. As part of this, we have to understand there are three key types of accounts or buckets that you will have in retirement. It's important to understand these different buckets. So we're going to start out with our pre-tax bucket or our traditional accounts. In this pre-tax bucket, you have your pre-tax 457Bs, your IRAs, 401k, and then I also like to lump your pension into this bucket. The reason I do this is because this bucket is the bucket that's going to be taxed at ordinary income tax rates in retirement. It's important to understand with these retirement plan contributions that we're making today, we're deferring our taxes or we're putting those taxes off into the future. So it's really important to understand this concept. One of the biggest mistakes I see public sector employees making with their savings is they dump everything into this pre-tax traditional bucket. Our next bucket that's absolutely critical is our tax-free bucket. These are any Roth accounts you have. Could be Roth 457B contributions or Roth IRA contributions. I like to think of this as you're prepaying your taxes at today's rates. A great thing about Roth accounts is they provide a lot of flexibility in retirement in that you don't have to pay taxes on that money. And the last bucket are our taxable account buckets. This could be your bank account, a taxable brokerage account, CDs. This is all money that is taxed at long-term capital gains rates. What that means is, let's say you put $1 in to a taxable account today, and it grows to $2 tomorrow. Well, actually, $2 next year. To get the long-term capital gains rates, we have to hold that money longer than a year. So you're only going to pay tax on that growth from $1 to $2. So you're only going to pay tax on $1. Taxable accounts don't have a lot of the restrictions that our pre-tax and our post-tax or our tax-free buckets have on them. So this gives you a lot of flexibility in retirement, especially if you're retiring early, that can really help bridge the gap to those later retirement years. One of the examples that I like to share about the importance of having tax diversification with these three tax buckets is that, let's say in 10 years you wanted to pull out $100,000 for hopefully something fun. Hopefully it's buying an RV and traveling around the country. Well, if you were to pull that full $100,000 out of a pre-tax account, you're going to pay a lot more in taxes than if you had pulled it out of a Roth account at no tax consequence, or if you had strategically converted that $100,000, a little bit of that each year. So let's say we're going to convert $10,000 over the next 10 years from our pre-tax bucket to our Roth bucket. If we were to do that, let's say $10,000 each year, I'm going to use round numbers. So let's say we're paying 10% tax on that $10,000 conversion each year. So we pay $1,000 in extra tax each year to move that money from a pre-tax to a post-tax account. Over 10 years, we would be paying $10,000 in taxes. However, let's compare that to if we were to just pull that $100,000 lump sum out of a pre-tax bucket in 10 years, we would probably pay somewhere around 20% tax on that money. So that would be $20,000 in taxes. So the difference between those two scenarios is $10,000 in tax that you could have saved. Again, I'm just using round numbers here to generally give you an idea of how this situation works. Your situation is going to be a lot different, and I'm a big fan of creating those 3 different buckets to give you the ultimate flexibility in retirement. Let's talk a little bit now about moving throughout your career. How do you save and where should you save? Again, these are general statements. This is not specific, so don't take this as a specific recommendation to you. If you're early in your career, oftentimes Roth accounts make a lot of sense. You're in your lower earning years, you're paying less in taxes, so contributing to a Roth account during your early parts of your career potentially makes a lot of sense. However, if you're more mid-career and you're watching this video and you're like, dang, I don't have anything in my post-tax or my Roth bucket, well, I would recommend you review your tax situation with a professional and see where are we at today versus potentially where are we going to go, as well as how's our pension play a role in that. And sometimes it makes sense to start building that Roth bucket, even if you're paying a little bit more in taxes today than you otherwise would. However, there's a lot of balancing that goes on with that. So again, not a specific recommendation. As we get closer to retirement, we really want to evaluate what are our balances in each of those 3 buckets and how do we maximize our income and reduce our taxes going into retirement. We want to think about, does it potentially make sense to hold off on pulling our pension for a year or 2 so we can convert a lot of that pre-tax money into a Roth account? Or do we just want to potentially do a little bit each year? Regardless of what method you choose, you need to have a plan for unwinding those pre-tax investment accounts before you get to the point where the IRS says, hey, you really got to take this. The IRS is impatiently waiting for their cut of the pie. And at 73, you have to start taking what's called RMDs, or required minimum distributions. The IRS says, hey, you have to start taking this out. We want our cut of taxes, and you need to do it. So now let's address some common myths that I hear all the time. Let's start with potentially the most common one, is that my pension is enough. I don't need to be saving anything beyond my pension. And this couldn't be further from the truth. Generally speaking, if you've worked a long time in the public sector, your pension is going to replace somewhere in the neighborhood of 50 to 60% of your income. And with rising healthcare costs as well as inflation, you need to have additional savings. You do get a COLA with your pension, however, you have to save more. Another common myth I hear is that I can't contribute to a Roth because my income's too high. There's a process called the backdoor Roth, which allows you to still contribute to a Roth account, even if your income's too high. It's very nuanced. There are lots of steps, lots of things to be aware of, and it's too much to cover in this video. However, I want you to be aware that you can still get money into a Roth account, even if you're at those higher income levels where you can't contribute in the traditional way to a Roth. The last myth I hear is that tax planning isn't important with a pension, and that couldn't be further from the truth. Your pension is taxed at ordinary income rate, so everything else you do in retirement and how you want to fund your retirement needs to be factored into this scenario in addition to your pension and Social Security. It's so incredibly important that we're taking steps to diversify from a tax standpoint today. So let's start with some action steps. I'm all about action steps, and I want to give you concrete things to think about and to do right now. So let's start with pulling out your pay stub. Just get a general sense of where the money's going and how it's being deducted from your paycheck. How much are you paying in taxes? Are your retirement plan contributions pre-tax or post-tax? How much are you contributing to your pension? These are all questions that can be answered from your pay stub. Next, I want you to log into your DRS account. Get in there, see what your service credit history looks like, run a pension projection, see if this correlates with what your long-term financial goals are. We also want to take a close look at how much are we currently saving for retirement. And this is going to be very dependent upon each person's situation in terms of how much you should be saving. But just start with understanding how much are you saving? How much are you putting away with your pension? And how much are you putting away on top of that? It's so incredibly important to understand your savings rate. Then we want to consider increasing our savings contributions by as little as even just 1% each year. You want to contribute on a regular basis and an automatic basis to those savings accounts, and increasing them a little bit each year is a great way to set yourself up for a successful retirement in future. And then, not to toot my own horn, but consider scheduling a time with a professional to help review your situation and understand exactly where you're at. Professional help can be so valuable, whether you're just starting your career or you're towards the end of your career. Having a second set of eyes to look at your situation can help you see things that you might not otherwise see. All right, let's close this up with another analogy that I love. I love fly fishing, and so one of the things I say to folks is we want to have different flies for different fishing conditions, and how you save for retirement could be thought of in a similar way. We want to have those 3 different buckets to pull money from in retirement. So a couple key takeaways. Start with Roth while you're young, considering switching to a traditional account as your income increases and your taxes increase. But we always want to maintain flexibility. And by having these 3 different buckets, we can maintain flexibility in retirement. Thanks for tuning into this video. If you'd like to learn more about potentially working together, feel free to go to lifefocusadvisors.com. Be sure to tune in to our next video.